Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Thursday, September 21st, 5:23 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. State of the market, we are in a mild correction, mild at least as far as the indexes go. Leaders getting hit quite a bit worse over the last couple of days. Check over here at the trend gauge. Leadership downgraded to bearish / downtrend as of today. Yesterday, uh, well, let me, in case anybody's new, we track market leadership and then we track the 5 major indexes across 3 time frames, and this dictates our exposure to the market. As of yesterday, all 5 indexes went from neutral to down relative to their 21-day moving average. They had been below the 21 for a while, but there was a big band of support right below there that was keeping us on neutral. That broke yesterday. Today, 50-day moving average, the last thing keeping us on neutral was the slope of the lines of the 50-day moving average. Those all curled down today. So we went to down / bearish on the medium-term 50-day moving average indicator. Long-term, mid-caps and small caps are below their 200-day moving average. The way these are weighted is over half of the weight goes to the NASDAQ 100 and the S&P 500, and then less weight to the Dow, small caps and mid caps. So that's why we're still showing the green arrow here, bullish uptrend, as the NASDAQ, the Dow, and the S&P 500 are the big cap indexes basically are still above their 200-day moving average. Small and mid cap below, at least the second day below as of today. So what happened today? Well, Jay Powell was very hawkish yesterday, put some fear into the market. Terrible day yesterday, worst day today. FOMC hangover is what I'm terming it. Broad sell-off, break below the 100-day moving average on the NASDAQ and NASDAQ 100 and the S&P. We'll take a look at that when we get into the charts, but here are the numbers and they're not pretty. Our 8 growth ETF composite, the RG8, down 2%, S&P 500 gap down 0.65, lost another percent throughout the session to end up down 1.64%. NASDAQ 100 gap down 1%, lost another 0.8, down 1.83%. Dow gap down just 0.3% of the gap down for the Dow. Most of the damage done during the day here, down 1.1%. Mid caps down 1.8, Russell gap down 1%, lost another 0.5% plus during the day, finishing down 1.56%. Global 60/40 down 1.14. This was mostly stocks. Bonds still were down as interest rates ticked up. Bonds down 0, global bonds down 0.37. Domestic bonds worse, the BND down 0.62%. In-house GROTECTION down 1.26%. We're down to one position, one individual equity position, and that's only for clients that came on board before the end of March. And that's NVIDIA with the big gains that we got on their first gap up on their earnings report. So anybody that came on board after that down a little bit less. And then, of course, we still have our S&P 500 position. We'll take a look at this and discuss that when we get to the charts. And then I've got one chart that crystallizes our approach during times like this with the market. Start off with the S&P 500 here. You can very clearly see the gap down right below the 100-day moving average and finished at the lows of the day. Where does this put us? Well, we're still above the breakout level from June and right at the levels of mid-August on the pullback and mid-June on the pullback. After that, we made a couple of gains, pulled back, tried to make another higher high, and we didn't. A lot of people are talking about this big head and shoulders here, and I see it. Everybody sees it. Sometimes when things are too obvious, they can't work. But um, we won't talk about theoretical. We'll talk about what's going on in reality, and that is that the market is not happy with the approach that the Fed is taken. One of the reasons the Fed said they were continuing to be so hawkish was because the economy was so strong. That's a bit of a head scratcher, but we don't try to rationalize what's going on with the market. We follow price, we follow volume, we follow trend, and the trend is telling us to get the heck out of the way right now. We want the wind at our back, not in our face. Right below here, we've got the 150-day moving average and then the 200-day moving average. Remember, I've said it 1,000 times, but I'll say it one more time. You've got to be able to live with a certain amount of losses in the market. Right now, we're down between 5 and 6%. The market bought off of its highs and in our portfolios. That's a very reasonable drawdown. And this is the area between the 100-day and the 200-day where markets need to make their decision. Is it going to be just a normal pullback, not even a correction? A correction is defined as 10%. That would take us all the way down here to be a 10% correction. So we've still got a long way to go there, but leading stocks we're basically all out of now, except for NVIDIA. And we'll let the markets, we'll let the S&P 500 decide how the sector rotation wants to take place. We're extremely oversold. And this area is prone to bounces higher and lower, considering how far down we've come over the last 2 days. And we're just not going to blow everything out because we're very likely to see a quick turnaround. Um, or maybe not. Maybe we continue to sell off, but an absolute waterfall. Am I expecting it to happen? No, but my expectations don't really matter, and we're prepared for anything. And that preparation, what part of that preparation was getting rid of the rest of our positions today as our stops were hit, holding on to the one that has a 55% gain since our purchase back here in March. That was NVIDIA, and holding on to the gains that we still have, double-digit gains in SSO. That represents our S&P 500 exposure, and that's how we play it. So basically, should we get down here to the 200-day moving average, our drawdown is limited now to basically 60% of 3.4%, because we're 3.4% above the 200-day moving average. We're down to the equivalent of a 60% position in the S&P 500. So 60% of 3.4%, or right around 2%, is about the drawdown that we would be looking at before we would break below the 200-day moving average and bring us to an all cash situation and or going short. So that's the S&P 500 and the explanation of the portfolio. Here's the NASDAQ 100, kind of similar. Gap down right around the 100-day moving average, closed at the lows of the day. Has not undercut the lows from August. So as bad as the last 2 days feel, I mean, we're still above where we were in August. We're basically right where we were in June. It's not all hell's breaking loose, but that's a Kiss song, by the way. That's my favorite band from back in the day. But anyway, I digress, and we will follow price. We'll obey price. Price isn't looking too good right now, and that's why we don't hold any individual positions any longer. Let's go to the Dow Jones Industrial Average. Uh, break below the 100-day moving average, still 0.8% above the 200-day moving average. This one's the closest of the big three liquid indexes to the 200-day moving average. The NASDAQ 100 still 9% away from its 200-day moving average. Long way to go to get down there. Mid caps and small caps, not good. Clear break now below the 200-day moving average on mid caps, and on small caps, their fourth close below the 200-day moving average with the gap down. And look at the relative weakness here. We've been talking about that for a while, and that continues, and it really needs to change because this just crushes the breadth numbers. and that's an indicator that we're keeping an eye on, always keeping an eye on. A lot of things go into dictating our overall exposure, including a lot of secondary indicators. That's one of them. But price and volume dictate mostly what we do. Switch to the VIX now. VIX got that big pop above 15, right into the declining 200-day moving average. That's where we paused on this last spike up in mid-August. Can we go a lot higher? We sure as heck can go a lot higher. This was when real fear was in the market during March. This was the bank sell-off, the banking liquidity crisis for regional banks. 1888, the recent high in mid-August, that corresponded to the sell-off of mid-August, and we haven't reached that yet. Although we did pierce that level on the S&P, we haven't on the NASDAQ 100. Let's go to the dollar. Dollar not helping anything. Off the highs of the day, closing near the bottom of the range, but still a higher high. Is the dollar. How did that impact precious metals? Well, SLV bucked the trend, gapping down, closing near the highs of the day, up about 0.5%. That seemed a bit anomalous. Gold down 0.72, gap down, GDX. We thought these things might be setting up, but a gap down 2.7%. You just can't get out of the way of a strong dollar from precious metalville. Let's go to the bonds. Look at the gap down below the range in the broad bond index, down 0.62%. Even worse was TLT. This is the long bond clear break below, all the way back to below last October's levels. What did this mean for yields? Well, very clearly they broke out. Shouldn't be a surprise. You can see that. Remember when we were talking about this gap up and the fear that this indicated back in February, and we ended up going lower, and this was an abandoned baby top. I haven't said that phrase in a matter of months, but obviously the bulls, if there are any left, want this to be a similar type setup, but we'll see what tomorrow brings. But for now, a very clear gap, and we're very extended on rates to the upside. TBT between 3 and 4 ATR extended above its 21, so we did offensive selling on TBT today, booking our gains on that. I showed TYX, that's the 30-year. Here's the 10-year TNX. Again, a gap up and closing, no let up, closing in the upper part of the range during the day too. And this is, again, all a reaction to the Fed's higher for longer stance that they took yesterday. One last inter-asset correlation chart is Bitcoin down 1.2% on the day. All right, let's go to the tail of the tape, mild correction. As I said, big spike in the VIX, under the bear case now with the sustained breakdown. As if there wasn't enough problems, we're looking at a potential October 1st government shutdown, day count from 1 to 2, 80 EMA and 21 EMA, fifth day below. Broke support on the S&P. Not quite a break of this 354.71. That was the mid-August low on the NASDAQ 100. As far as sectors go, the dollar and silver and bond yields, the only things up. Oil started the day strong, ended the day red. 11 out of 11 sectors down. I can take silver off this. It was just gold and gold stocks. Basic materials, XLY, which is discretionary, that is led to the downside by Amazon, down 4.4% today, and real estate hit hard, down 3.5% today. So all 11 sectors were down. These were the these were down. These three down 2% or more. A broad sell-off, as I said. So far as the portfolio goes, sold Lilly, small loss on a 2% position. Sold the rest of Uber. That gain went to a small loss. Sold Tesla, half of it for a small loss, half of it for a small gain. And as I said, offensive selling on TBT. That's the interest rate that goes up as interest rates go up. It was quite a bit extended, so offensive selling there. Bottom line, FOMC hangover, the sell-off continues. Broad sell-off. S&P 500, NASDAQ broke their 100-day moving average. We're looking to see what would happen should we get a bounce into that 100 level. First of all, let's take a look at the individual charts of what we sold today. Lilly breaking the 21. We've got maybe 6 stocks, 7 stocks in the 21 over 21 that are still above their 21. Another reason why leadership went to bearish today. On the trend gauge, Uber, very clear break of the 21. Very nice trade, all for naught as of today. Tesla broke the 21, sitting basically right on its 50-day moving average. And TBT, this was the big gap up, almost 4 ATR extended, did offensive selling there. So what are we holding just for pre-March, mid-March clients? NVIDIA, it's sitting right on the 100-day moving average. This and the 400 level are the line in the sand for this last position that we've got the 50+% gains on. So in the headline of the email today, I say, as the sell-off continues, this one picture summarizes our approach. That's our approach under times like this, and here's what we're looking for. This is a picture of the NASDAQ 100 from January to March of this year. We've had a prior uptrend from January up till February, and then the market started correcting. Here's the S&P 500, this black line up here, what it's doing. So the S&P was acting strong in an uptrend, but it's a little hard to see because it's intermixed with price, but the jagged blue line here, and I tried to smooth it somewhat by just drawing the red line so that it stands out a little bit. But basically, the NASDAQ 100 was gaining more than the S&P at the time, so it was in an uptrend. We're looking for things that are outperforming the S&P. The NASDAQ 100 certainly was at that time. Then we started a correction right at the beginning of February. This is what the NASDAQ 100 did. It corrected along with the S&P 500. You can see the S&P 500 correcting here. But on a relative basis, it stayed basically in sync with the S&P 500, and that's what the red line is, and this is what we're looking for. Typical growth stocks go up more, and this fits the bill for the NASDAQ 100 and the Big 7 too. They go up more than the S&P 500 in an uptrend, and they normally lose more than the S&P 500 during a downtrend, but that wasn't happening during February. This red line shows that the NASDAQ 100 was just going sideways while the S&P 500 was correcting, and this is what we're looking for as leading stocks continue to form bases during this sell-off here. We're looking for things where the chart might look bad, but on a relative basis, you're either seeing improvement or outperformance against the S&P 500. And then toward the end of March, we broke out of a base on the NASDAQ 100, and NASDAQ 100 stocks went to lead a very nice rally relative to the S&P. You can see the S&P 500 breaking out at the same time. So this really crystallizes the approach that we're looking at right now while the market corrects. We want to see what is showing relative strength against the S&P 500, what is holding up, and the odds are that those stocks that are holding up right now are going to be the leaders when the market correction ends. So we're looking for what's holding up. We're looking them to form a base. We're looking for relative strength, preferably as it closes out the right side of the base. And then if it breaks out of a sound base corresponding with a follow-through day or additional strength in the S&P 500 and or the NASDAQ 100, that's what's on our buy list. That's what we'll focus on. That's what we'll pounce on when the market stops correcting. So to summarize it in one picture, a lot of leading stocks now have outperformed the market. We focused on a couple of them, booked some gains on some, but some of them just really started languishing recently. And that's what this part of the correction represents. They stop outperforming, maybe fading a bit on a relative basis, or at best case going sideways. Uh, then broke lows during this consolidation, and this is kind of where we are in a lot of leading stocks right now. They went sideways while the market was correcting, but then we broke down. They broke down very similar to the way we broke down the last 2 days, but on a relative basis, they didn't. So the chart will look bad, but the relative strength line won't. And then when we start trying to come back up, look how bad the S&P was and the NASDAQ 100 was on a price basis during the beginning of March. But on a relative basis, it was actually doing better than the S&P 500. And this foreshadowed the strength in the NASDAQ 100 that we had after we broke out in the middle of March and went higher. And a lot of those big seven stocks led the way, and there were a bunch of leaders that had decent gains as well. And this is basically the picture. Think of it as a familiar face in a yearbook if you want to. We're looking for this type of setup, something that's going to lead once the market rights itself. So it stops going down on a relative basis, might be going down in price, but on a relative basis, it's hanging right with the S&P. And these are normally the leaders when the market rights itself. So I wanted to spend some time on that, as that's what we'll be spending our time on during this correction. No sense being a hero when the wind is in your face. We're out of the way, except for probably 85% of our clients still have a small piece in NVIDIA, stopped out of everything else. And we've got our S&P 500 position, which will cut a little bit if it starts getting worse, but we're willing to live with the 2% drawdown as we're in this range between the 100-day moving average and the 200-day moving average, because when you're oversold, you can expect to bounce at any time, might get a little bit more oversold, but I can't predict exactly what the best way and the best approach to the individual sectors is right now in the S&P 500. I just know that I'm basically not at a disadvantage, not at an advantage. I'm willing to live with this little 2% gyration that will do. But if we break the 200-day moving average, we know that all bets are off, because that's where all bear markets occur. And with that, I'm going to wrap up today's video. As always, like your feedback. Emails don@revereasset.com. If you're interested in becoming a client, we've been having a lot of calls lately. People watching our videos, liking our approach, like our transparent um, approach to the markets, growing when the market goes up, getting out of the way when the market goes down, really getting out of the way when the market turns ugly. Email my partner if you're interested in becoming a client. That's dan@revereasset.com. The phone is 855-REAL-WEALTH. That's 855-732-5932. While the market has had this sell-off, we've lost basically about the same amount as the market has. We consider that a win when you're in growth stocks. They outperform on the upside. They also outperform on the downside. But between this and the passive approach we take to with the SSO position and the S&P 500, all of the stocks, individual names, as I said, we're out of now. Right now, not a big edge either way in the S&P 500 between the 100-day moving average and the 200-day moving average. I detailed what we're willing to lose during this period. I'm showing a chart in the video, but the S&P 500 basically is the same approach. So um, during this sell-off off the top, as I said, kind of in sync with what the market's doing, and we're okay with that. It's when you get below here that the carnage begins, and that's when we take maximum defensive action. Anything else is just dumb, in my opinion. If you're not getting out of the way below the 200-day moving average, when we know historically that's where all bear markets occur, that's on you. And with that, I will wrap up the video for Thursday, September 21st. This is Don Vandenbord with Revere Asset. The bearer of bad news, but don't shoot the messenger. You need to know what's going on, and I'm here to tell you. Thanks for listening, and have a great day.